Welcome back to Inside Options. I'm speaking to Sebastian Mudley from Corporate and Investment Banking at Standard Bank. And we're talking about currency options, when you should hedge, why you should hedge, some of the benefits, some of the risks. So Sebastian, we've got quite an interesting table here with some graphs. So what would you say is just the main difference between hedging with futures and hedging with options?
The fundamental difference is that a future, whilst it protects you against unfavorable movements in the currency, it does not allow you to participate in favorable movements.
Okay.
So it locks in a rate that you are guaranteed to trade at, but assuming for an exporter, the rand had to depreciate by the actual maturity date of the contract, a future will not allow you to participate in that depreciation of the rand. An option will. So effectively, you can walk away from your contract and you can participate in that rand depreciation.
Now, the one thing I was chatting to you a bit about this in our preparation for the show, and it really struck home with me that it's kind of like insurance.
Exactly.
You know, that you're taking out this option because you're worried it might move against you. Let's say, for example, your house burns down.
Yes.
You've got insurance on your house burning down. You really don't want that to happen. It's not cool. But you do have insurance. So with these options, you almost don't want them to end up in the money. So It's not like speculating where you say, here's our break-even point, this is what it costs us. So with this table up here, we can see these different options. For a sort of at-the-money forward, 3-month option, R6.94.
Yes.
When we priced it, the spot was 6.85. So you can see that difference there of the forward. 21 cents premium.
Mm-hmm.
So that's going to protect us at 6.94. And you're paying away 21 cents per dollar for it. But you don't actually want that to happen. You want it to move the other way and be in your favor.
Exactly. So you actually want the rand to be trading well above the 6.94. In other words, it's an out-the-money option as a client. That's what you're looking for, because then you get to participate in the rand weakness.
Okay, that's it. So you can lock in a floor price or a ceiling price for your currency, but then participate in any upside separate to that.
That's 100% correct. That's exactly what you're looking for. So you're completely protected against your unfavorable movements. For example, if you look at a company, they could actually determine what rate would really hurt them from a cash flow and a profitability
that disaster area.
Exactly.
I mean, I know my dad's business, he imported stuff, sold it, massive moves in interest rates in the rands after the Rubicon speech. And if he'd been able to hedge, his business could have survived. He had to get taken over by someone else because his business couldn't survive those massive exogenous shocks.
Exactly,
that
which you could never expect.
You could never predict those.
Exactly.
I mean, there was some crazy politician made a speech. It wasn't the speech people were hoping for. Massive capital flight. So that's where something like a 3-cent option to protect you for the next 3 months, just as a disaster protection, you know, it's starting to look like, hang on, maybe just to get 6.30. If the rand goes to 5 and the dollar collapses, I mean, there you go. You've got some protection.
Exactly. And I mean, if you think 3 cents is a lot, if you just need to look at the dollar rand moves in a day.
Yes.
You know, the rand can move 20 cents in just a day.
Exactly.
So 3 cents doesn't seem as much if you can protect the rate, which could really hurt you from a profitability point of view.
You know, and that's just the worst feeling. You know, you've done your business. You've sort of done everything expected of you. You managed to sell your product. Suddenly, Forex moves against you. You can't pay off the debts you owe.
Exactly.
You know, and you just feel like you let everyone down. It's not your fault. It's the market's moved.
Mm-hmm.
But you can protect against it.
Exactly. Yeah, I mean, for me, this is one of the best solutions to protect against it. You do pay the premium up front. You can work out ways of deferring the premium to maturity of the contract. There are flexibilities associated with that. The good thing about it as well is that you can do a little bit of what we call active currency management, which is as the rand depreciates, you actually take advantage of it as it occurs, rather than wait for maturity of the contract.
Yes, so you sort of sell off a bit of it and sort of change it to futures or something.
Whilst always having your protection.
So you just keep that base protection, which is so important because it creates certainty when things are uncertain out there, especially at the moment. I mean, global economic conditions, it's quite scary out there. Sort of looking at the Eurozone, Greece, are they going to default?
Exactly.
Italy's sort of credit ratings plummeting. The US, they've got these big debt talks on. Around the world, it's scary stuff.
Yes.
And currency markets is one of the places it plays out.
Exactly. I mean, you have no idea where the rand's going to move on a daily basis. Even from a trading point of view, it's very difficult to actually anticipate where those rand moves are, because we're completely vulnerable to what's happening in the US and what's happening in the Eurozone.
Exactly.
And you know, these
even China.
Exactly, even China.
It has an impact on us. So, I mean, are you also seeing quite a big move towards on-exchange trading from a lot of your clients?
Yes, we are, just because of the need for transparency.
Yeah.
And, you know, your YieldX products actually offer that transparency. So in terms of options and currency futures as well as currency futures, definitely a growing trend in the market.
I mean, the growth we've seen, I don't know if you know these stats, I was chatting to one of my colleagues, said 95% growth in volume between the first 6 months of 2010 and this year, the first 6 months of 2011.
Geez, that's incredible.
It's amazing.
That's
I mean, it wasn't tiny in 2010.
Exactly.
And now it's really, that market is growing phenomenally.
Exactly.
And it's small businesses, retail guys wanting to take a view, trying to, I mean, you can even hedge your holiday. I mean, another of my colleagues hedged his holiday expenses, worried about the Forex move. So he just locked in his price, had some certainty.
Yeah, I mean, it's the best thing to do when you are concerned and, you know, get to spend some more money on clothes while you're holidaying.
Exactly.
At least you get some sort of protection on your actual exchange rate, and you're good to go.
And you lock in a limited downside with the ability to still participate if it moves in your favor.
Exactly.
So that's the main thing we look for in options when you're a hedger.
Yes.
Rather than just a speculator.
Yeah, exactly. And I think a very important thing to remember as a hedger is that with an option, you're always protected.
That's very, very good to know. Thanks so much for being with us tonight, Subhashini. Thanks very much for watching Inside Options with me, James Boardman. Next week, we'll be back with the textbook stuff to teach you how to be your own option traders. Till then, goodbye.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.